everybody, and welcome back to the Thought Leadership Webcast series. With me today is a bond fund manager of impeccable credentials and experience, Ed Devlin, who is a household name in Canada and in several corners of New York, London, and Tokyo, where he spent a good chunk of his career. Ed was an absolutely huge moneymaker when he was on the bond desk at Merrill Lynch, where we first met well over 20 years ago. And then he went on to have a storied career at PIMCO. He worked closely with Bill Gross and Mohammed Al-Arian, and then went on to come back to his base in Toronto, where he established PIMCO Canada. And in the short span of, I think it was 15 years, Ed, you took the AUM from PIMCO Canada from its infancy, zero to $50 billion. And that was more to Ed's return generating capabilities than just his marketing strategies to attract new clients. And I do believe that over his tenure, in classic Bill Gross style, Ed outperformed his benchmark, or what we call the bogey, by an average of 100 basis points per year, which in the fixed income business is an absolute home run. There was hardly an institution that did not have money with Ed by the time he left his business 5 years ago. And he left to start his own fund, Devlin Capital, where he does his core competency, which is uncover value in all aspects related to the fixed income market, and not just North America, but around the world. I should add, for full disclosure, that Ed and I go on the Business News Network once a month for a solid hour to go through our views. And actually, we've been more in agreement than disagreement these past few months. That doesn't always happen. But we'll see today how much of that has changed of late. So, Mr. Devlin, it's a pleasure to have you on the call. Take some time, by the way, to tell the viewers a bit about yourself, your history, how your history, especially at PIMCO, how that's influenced your investment philosophy and your style. And also, of course, the main reason you're here, which is to delineate what your current macro market central bank policy views are. And then please instruct us as to how you're translating all of that into your portfolio positioning and construction. And then we can handle questions from the crowd that come in and turn it as usual into more of a fireside chat. So with all that, Ed, take it away, my friend.
Oh, great. Well, David, you're too kind. Thank you very much for that. I'm not sure if I was that well, if I deserved that high of praise in introduction, but thank you so much. David and I go back over, I think it's 25 years now, where we were colleagues and became friends at Merrill Lynch. And then we reconnected, quite a few years later when I was at PIMCO in Newport Beach, and Dave was the chief economist for Merrill Lynch, North America. And one of the funnier stories, and one of the classic Dave and I have, kind of have a relationship where we agree often but disagree in a very friendly way. I remember one of our colleagues was hosting Dave at Newport Beach, and it was just before the housing market, and both PIMCO and Dave were a little bit early on the call, but eventually we're spot on in that the U.S. housing market was going to correct meaningfully. And my friend says to me, I got to run. Can you host David Rosenberg, with a big group of people at PIMCO? I said, I'm happy to do that. And so Dave comes in, and Dave, as passionate as Dave normally is, comes in and goes off on, why the housing market is, going to go down. It hasn't gone down yet. So we were early and, waiting for it for about a year or so. And at the end of this, 10 minutes of, tons of data coming out of Dave's brain to everyone. He goes, I just don't understand why anyone would not have this view. To which I reply, so I look around the room and no one seems to want to take that. And I said, well, Dave, here are the 4 or 5 reasons that would be against, the view. And Dave then goes off for 15 more minutes on, and he kind of basically said, Ed, I thought you were smart, you're stupid, and then this and this and this, and goes through song and verse, everything about why. And after a long period of time, I go, Dave, I agree with you. You just asked me what the opposing argument was. So anyway, Dave and I have a very good relationship going back a very long time. So thank you very much for the opportunity here, Dave, to speak on this call. I did start my career in the sell side. I was very, very lucky to early on in my career be moved around. I spent a good chunk of the 90s in Tokyo, and that's when JGBs were at 4% and watched them fall all the way down to like 1% in yield. So it was a very enlightening experience because that later on and over the next coming decades, I watched the same thing happen everywhere else around the world. So it was a really good education, if you will. And then I was very, very lucky to be recruited into PIMCO, where, as Dave said, I was recruited to start PIMCO Canada. I used to sit a few feet away from Bill Gross and Mohammed on the trading floor. While I was there, and as 07 and 08 ramped up, I used to be on the sell side. I did structured interest rates and structured credit, so I ran the gamut of the markets, if you will, from Europe to Japan and back. And so we were there were high yield. There was real good opportunities in high yield tranches, but none of the high yield folks could do it. So Bill asked me to go over and do that for a while, and we kind of fixed up the trading operations and exploited opportunities there, which were great. And then as the crisis unfolded in 08, Europe had struggled for PIMCO more than the U.S. and North America. So Bill asked me again to go out with a couple of my colleagues, Mike Gomez, who's in emerging markets, and Andrew Balls, who's a macro person. And I picked up with the European, what they call LDI portfolios. And those are liability-driven investing. And for those who may have remembered when the Elizabeth Trust blew up the budget, and do you remember there was all the funds that went to zero, and the Bank of England had to come in a couple of years ago and bail everything out? Well, those were the funds I ran. So luckily, my phone rang off the hook when that happened. But and I used to say no to a lot of our marketing guys who'd say, hey, Insight's doing this and LNG's doing that. And I was like, that doesn't look prudent to me, so no. So I was joking with my colleagues, you're thanking me now, because PIMCO didn't have any issues. But so I did that for a bit. And then when Mohammed left, Bill asked me to come back to the US and take up some US total return portfolios. So when I retired, I was running about 25 US portfolios, and I was running about 35 Canadian portfolios. So I kind of have a bit of a global background, and kind of a broad experience across kind of the global market. So I kind of retired because it was just into the pandemic when interest rates were really, really low and term premiums were very, very low, and the central banks were flooding the zone with liquidity. And I just didn't see any opportunities to really make that 100 basis points or so of alpha that we had done for the last quite a long period of time. And so I thought it was not a bad time to take a step back and see what else to do. And then interest rates popped up again, as they have. Inflation popped up. We know what happened in the pandemic. And the reason I decided to start my own firm was, I think there is I used to be, call it the captain of an aircraft carrier before, and I really think there's opportunities to be the captain of a speedboat. So bringing the skill sets that I developed over the decades, and the PIMCO knowledge. I'm a huge PIMCO fan. Full disclosure, I still have a good chunk of my net worth there, so I'm rooting for them. I'm not, kind of thing. But to bring that knowledge base, but apply it in a way that can be more nimble and get in and get out, be a bit more scalable, stay more liquid. And so that's really the strategy. It's basically a very global orientation towards global macro alpha, and then bring it to whatever local market you want to invest in. We started in Canada. We'll be moving to the US hopefully shortly. but do it in a way that's more nimble, where you're not moving a $2 trillion balance sheet around. You're only moving a few billion dollars around, which makes it a lot easier in terms of getting in and getting out of markets without paying too much of a transaction cost. So that's really the background to where I stand here today, and why I'm here today, I guess. In terms of the markets themselves, I thought maybe what we'd do is maybe try and take a step back. One thing, PIMCO was, and I am or is still, I guess, a long-term fundamental investors. And what do I mean by that? Try to outperform over a market cycle, over a 3 to 5 year period. You're never going to time it perfectly, but if you can have strong views on where the market should be, you'll never get it necessarily right in the short term. But if you do your research and do your homework and understand what's being priced in, over a business cycle, you can dependably make money. And I firmly believe that. And that's kind of the approach, I bring. So in terms of looking at, the markets, taking a step back, let's kind of take a look, where are we and what's transitory and what's not and what's fundamental. If you think about it, pre-pandemic, after a decade of policy rates effectively at zero, we were just starting to come off the zero bound. I think Fed funds were at like 2.5. Bank of Canada up here was at 175. And core inflation was running around 2, which is around the targets the banks want. And boom, the pandemic hit. So, and the problem we had, by the way, pre-pandemic was inflation was too low. It was running around between 1 and 2. And the whole thing was, how can we get it to go up? Right? We couldn't get inflation higher. That was the struggle of that decade. Pandemic hits, we closed down vast swaths of the global economy, most of the services, and we, spend like drunken sailors to, create, for good reasons, to create social cohesion and make sure those most vulnerable in society, can get through, which are all the right things to do, in my opinion. Obviously in doing that, we had what commonly is referred to supply chains being disrupted. I would just say we had a shrinkage of supply. We a whole bunch of things went wrong, and these are all things that I've never seen in my career. A pandemic hadn't happened in 100 years, and 100 years ago, we never thought you could spend that much money. And by the way, all financed by the central banks. So the central banks were printing the money, buying the bonds, and allowing the governments to give benefits to, away to various people in society. Some of it very, very, worthy and justified, and quite a few not. And I think that's what's created some of the problems we've had, in the recovery. So we reopen. Not surprisingly, we closed the global economy down in a very uneven way across regions and industries, et cetera. And we reopened in a very uneven way. And, inflation shot up, right? Why did inflation shoot up? Well, supply, there's a couple of different things. One was supply and demand weren't meeting each other because of some industries, think of restaurants and services, there was no people there. We had to rehire, we had to get things going again, et cetera, et cetera. And other things, we had problems with, critical components to a car or whatever, different products. Maybe there were chips or different things, and we couldn't get things, we had just-in-time manufacturing before, and now we had, products and manufacturing in different spots, and they weren't, connecting in the way they should have. So, that's, and on top of that, by the way, yes, generally fiscal authorities around the world, and G7 anyway, the developed world, we spent too much. Now, you can make that judgment, in my opinion, after the fact. Larry Summers, I think, had a pretty good call on it. Can't remember, Rosie, if you called it at the time or not, but, I know I didn't. I was like, because again, it was a pretty fuzzy time. No one had an economic model that, modeled a pandemic, at least the way I thought of it. And so, you had super loose monetary policy, and which was funding, the fiscal expansion. The central banks did a thing called QE, which was basically bond buying. So they bought the government bonds, the government gave the money away to whoever, kind of thing. So all that creates a massive spike in inflation, and then the central banks realize, oh my God, they're behind the curve. We have a big jump higher in interest rates. And the one thing I kind of knew at the time is, they're going to get this wrong. They're going to keep it too tight for too long, but I just don't know what that means exactly. So I knew as an investor, it was going to create opportunities for us, because what you've got, if you think about it, in the end, where do we stand now? Supply and demand starts to come into balance as, the profit motive. We didn't get rid of capitalism. We didn't get rid of the profit motive. So these different, industries, the supply and demand came together. And so we've seen inflation come down. At the same time, savings rates have been brought down. So a lot of people, had money, but they couldn't buy a car. They couldn't go on vacation. So, there was all these temporary things that, cost of going on a vacation went up. Well, because everyone wants to go somewhere. We've been in our houses for 2 years. So these are like little quirky things kind of happen, but you knew that wasn't going to be forever. But you just didn't know how long. And we've kind of worked through that process now. So in the end, what was temporary? Well, a lot of these dislocations in micro markets turned out to be solvable and have largely been solved. And, but what's fundamental? Well, in the end, we've got this massive debt stock that's sitting with central banks who don't want to be the lenders, and we've got high interest rates that are crippling to massive debt stocks. So they're going to, they're going to by definition be a drag on growth. They're going to, because they're going to take tax dollars away to pay for interest on the debt. And then at the same time, you've got central banks are reversing what they call QE, or quantitative easing, to QT, and they're letting the debt roll off the balance sheet, and they're saying to the private sector, to us, to the PIMCOs of the world, can you guys pick it up? And we're like, yeah, we'll do it, but that's at a different price, a different yield. It's not going to be the one the government wanted. And so you've seen this massive move up. So to me, like the obvious, and Dave and I, you and I have been talking about this for months now, was that over-indebted economies, Canada is a particularly bad one, and the G7 just can't handle these massive debt stocks. And so rates are going to have to come down. If pre-pandemic, the real interest rate was sitting at 0, and all we've done is bridge a gap by spending a ton of money that we borrow from central banks, I don't see a ton of productivity there. And how can real interest rates be any higher today than they were before? And if you take that basic model of how could real interest rates be any higher today than they were before, well, that tells you that if we've got inflation coming down to around 2, ish, the Fed right now is closer to 3. The U.S., Canada today had a good report and about 2, a little less. Then, we're probably talking a 2 or 3% policy rate, get you back to kind of 0 real. And it's a long way from where we're priced right now. So it's been a really good opportunity to be long interest rates, be long the bond market. And there's been term premiums, a lot of things that have been out of whack that, it's been an excellent market for active investors. I just launched my fund, a few months ago after getting regulatory approvals up here. I wish I could have gotten in earlier because, Dave and I were on this thing. But, I still think there's probably another year, maybe 2. We'll see how the market plays out, where I think you can actually get kind of high single-digit returns in the bond market if you pick a good manager with some skill and be just conservative. And this is not swinging for the fences. And, compare that to, inflation. That's kind of nice inflation plus 4, 5, 6, depending on the day. And compare that to stocks, which have had a heck of a run, over the last little while. And so, I'm kind of a bull on this sector. That's hence why I'm back in the market. I think we can really make money for our clients. And I think it's an exciting time to be, in the markets. So that's kind of my kind of big picture context. And then I'll kind of go through a little bit, what's going on around the world. But I think it's a great time to be in fixed income. I think those fundamentals haven't changed. There's a lot of noise, and by the way, this noise, there's an old saying, volatility is an active manager's best friend. And, we just saw front end US rates rally 200 basis points, now sell off 50, like all that, it creates great opportunities for fund managers who have, a longer term North Star, i.e. fundamental style of investing. The other thing I think is kind of interesting that just went on right now is that what I find very interesting, and Dave and I have talked about this before, is, we had an inverted yield curve in the US, but other countries, probably the longest inversion that, Dave, I don't know, in history, I think probably since World War II or something like that, or at least our careers, kind of thing. So, why did that happen? Right. And again, I think it's because, the savings, like all the quirkiness around savings rates and consumptions and how people do it, didn't play out quite as on time. It was different. There was different for different countries. It played out, much more quickly here in Canada. It is playing out much more slowly in the U.S. And again, we had this massive amount of fiscal spending that the savings rates didn't quite come down as evenly, given how the checks went out. And so, hence why it was just a lot longer than I would have thought, to be honest. But we're working through it, and that's that's where kind of where we are today. So if you'd have asked me maybe a year ago, what are the odds of a soft landing? I'd have probably told you 10%, kind of thing. I would have said, if you looked at all the various scenarios, soft landing is when inflation is up at 8-10%, depending on the country, that you're going to get inflation down to, call it 2 or to target, and not have a recession, and then have net growth, and you're going to have labor markets that are not going to fall off a cliff. I would have put a very low probability on that. Well, you know what? Fast forward the tape to today, I would argue that the markets are pricing in a soft landing in the U.S., at least the stock market and the corporate bond markets, which are corporate bond spreads are very tight. So if a year ago that's what it was, I was just looking. Today our investment committee, we were talking about the various things. It's like, if you look at the various scenarios, we'd say kind of like, what about the scenario of high inflation and high growth? 5%, we would say. What about stagflation? Possible, probably a little higher, 5 or 10%. Soft landing, well, a year ago, would have said it's 5 to 10, probably like 30 or 40% now. But I'd probably, Dave, more in line with you. I would say a kind of low growth or recession is still the most probable outcome, probably in the 50 to 60% chance. So, that is how, in general, how I've always assessed risk and invested in markets is you never invest just based on a pinpoint estimate. You want to look at, what is your base case, but what is your tail risks? What's, the good scenario, the right tail, the bad scenario, the left tail, and adjust your scenarios based on the data that comes in, and then merge those scenarios with what's being priced into the markets. And that, is kind of our approach to active fixed income, if you will. The other thing I think that's kind of a big macro thing to keep in mind when you're thinking of the global bond markets and how they synchronize and desynchronize is a critical market is the mortgage markets. The mortgage markets around the world are very, very different. So the US has got this incredible liquid, deep 30-year fixed market with a lot of prepayment risk, where you can prepay your mortgage early if it's to your advantage. If you look at the UK, it's like a floating rate market. It's based on the 3 month, 6 month type floating rates. Canada's kind of in the middle. It's it's more of a 4 or 5 year market, if you will. Why does that matter? It matters because how much is people locked in their financing? If you think about it in the US, if you've got a very, very valuable financing rate, if you've got a 4% or less mortgage, and you get a job opportunity and you have to go, across, to another state or to another city or whatever the case may be, unless you get a big raise, you can't afford, your mortgage payments are going to go through the roof to go up. So I think it affects the real economy. So I think mortgage markets in general, when you're assessing fixed income, always focus on those markets because they are very different. And so Canada right now, we're cutting rates ahead of the US because, if we didn't, we'd be killing our economy because it's so interest rate sensitive. And every year, think about 20% of the mortgages come up to be refinanced. Whereas in the US, it can be whatever it wants. You've locked them in. And so, it got down where mortgages just a year or two ago had an interest rate risk or a duration of 1 year. Now they're up to 4. But, so they really move around, and it can affect the supply of bonds in the market, and it affects term structure of interest rates, what the yield curve looks like. So that's just another kind of general theme I wanted to highlight here on the call is watch your mortgage markets very, very, very closely. So like I said, I was just going to do maybe a real quick, spin around the world here and then open it up for Q&A. So in the US, we've got, the soft landing. To me, look, the soft landing is priced in the corporate bond market. It's priced in the stock market, but it doesn't look like it's priced in if I look at like the rates markets, which are moving around a lot more. You've had a 50 basis point adjustment in the last few weeks in the front end of the US yield curve. And that's just as the Fed has gone from really focusing on inflation to now focusing a bit more on jobs. And you had a good jobs report kind of thing happening. So the dual mandate. The Fed is, the markets are now pricing in, the Fed at 3.5% by, late summer next year. That honestly probably think it's lower than that, but we'll see how the data plays out. In our opinion, probably the Fed will, if the data stays in this zip code, will probably try to get itself to 4% Fed funds and evaluate what's going on. Again, monetary policy moves with, lags. So what's happening today is really a function of what happened a year ago or a year and a half ago. So but if the data rolls over, I can easily see, I personally, we think Fed funds will probably be through this business cycle, probably get down to the 2 to 3% range, if we're right on a kind of low growth recessionary base case. So there's still value in the bond market, but let's just watch it and watch the data and, the path dependency, if you will, as we get there. The one thing that's really good about the US market is while corporate investment grade corporate bond spreads are really tight, like 50 basis points, mortgage spreads are still cheap. They've come in, they were about 200, they're now about 150, but you can get really AAA rated, nice pickups to treasuries, the par coupon Fannie, Freddie, the agency liquid stuff that trades, $1 billion on, easy in a phone call. Those things are like I said, trading about 100, 150 over now. So you're picking up 100 basis points of spread. So in our portfolios, we own no corporate bonds, but we've replaced all that. And there's some of them are in our bogeys or benchmarks, as David was talking about. We just replaced them all with mortgage risk. And because that's the cheap risk and mortgages are expensive. So, it's just that simple. I think, there's a couple of things I'd like to talk about is swing factors. And especially in the US. So the big one is going to be, and David, my thinking's evolved since the last time you and I were on TV on this one. So the election, what's the effect of the election? I think David and I were talking last time. I was thinking, the House and the Senate might go with whoever wins the presidency, and then it'll depend on the Republicans have had a tough time, herding cats in the House. And so they might have a tough time implementing their fiscal policy. The Democrats under Biden and Pelosi seem to have threaded the needle with small majorities and maybe to get through. But I think now, I think I was wrong thinking that before, Dave. I think now is, I think the centrists in both the Republicans and the Democrats are now saying enough's enough with these deficits and debts. And I don't think they'll let any real fiscal expansion go through, whether it's tax cuts or spending cuts, because I think the center of both parties will say, that's it, had enough, we're not letting anything through, which, and I think that's closer to your old view, and I'm coming around. You had a divided government thing. I don't even think you need divided government. It doesn't matter which one it is. The center will hold, and I think that's going to be the check on the executive, regardless of who wins. And then I guess the next thing, the big thing is Trump versus Harris. It's 50-50 if you believe the polls. Harris, I don't see anything getting through of substance, so I don't think it has a big impact. Trump has been talking a lot about tariffs, and I've been listening to a lot of his his top advisors in his first term that have been speaking, and it kind of comes down to two things. One is he really believes in tariffs. I remember when I was in Japan, he was always beating up on Japan in the 90s, about tariffs. So I think he believes it. It's really a principle that he believes in, trying to get fair trade or managed trade or however you want to call it. But a lot of people, his former advisors say, it'll be more bark than bite, and he'll use it as a stick and then not actually have to implement them. Scare people into what he wants. And that would probably be a relatively benign, scenario, if you will. The other scenario is he does it, does what he's talking about on the campaign trail. And that could easily be a trade war kind of thing. So one of the things we're doing heading into November is, we've taken a number of our bigger risk positions off the table. Not that we don't believe them, but let's just take a little, let's just drop back 10 and punt, if you will, for a couple of weeks. And let's see what actually shakes out here and see if we can get a better assessment of it. So I think in terms of swing factors, or tipping points or whatever you want to call them, that's the big one in the short term in the US. On the more long term, that's a cyclical one. On a secular view, and this is not really US, but it's more kind of global, the things that we're keeping our eyes on that could really tilt our forecasts is and very hard to predict. Geopolitics, the Middle East, Ukraine, maybe China, those things you have to keep an eye on because they really could have big effects on the global bond markets. The energy transition, how does that go forward? Does it go forward fast, slow, smart, stupid? Hard to say right now, depending on the country. And AI, it looks like quite a, is it just going to be a supercharged Excel spreadsheet type of innovation that makes everybody more productive, or is it really going to have much more profound consequences than that? So I think having a longer term view, those are the three kind of swing factors we're looking at from a more secular perspective. And so that's kind of, I would say the US, et cetera. So then, and I'll just really quickly kind of go a little bit around the world to put it in context to see the linkages. China, I think, Trump was a transformational president for China. I mean, I think the view before them was, get China into the WTO. As they prosper, they will become more democratic. They'll be good actors, et cetera, et cetera. That didn't work out. And I think Trump was the first president to say, let's try to be a bit more contained. China's an adversary, potentially bad actor at times. Let's try to put them more in a box economically, militarily, geopolitically, et cetera. And, clearly Biden's agreed with them and kept most of those Trump policies in place. And my kind of view on China would be that's probably the base case in Washington now for some period of time. The next presidency, maybe multiple presidencies. So, with that in as a backdrop, they've got a good fiscal balance sheet, and you just announced the fiscal expansion there, but they've got a really terrible private sector balance sheet, a lot of bad lending there. So it looks like China has probably got the capacity to be growing slow for them, probably high for us. You never know their numbers are kind of never true, kind of thing. So, but they're not going to be the engine of growth globally. Who could be the other emerging markets? As we do nearshoring, as the West implements that China containment policy, you can see India, you can see Mexico with nearshoring, Indonesia, some other countries. Can they pick up the slack and allow for global growth to continue? The short answer is we think yes. We're not super bearish on that, but there's kind of a rotation within emerging markets. Eurozone looks to us like it looks weak. Look, Germany might be in a recession already. They've got huge geopolitical risk with Ukraine right on their doorstep. They've generally got a problem with coordination because they have a monetary union without a fiscal union. It's very hard to implement policy. One thing that we've benefited from, and kind of a cool trade we've got on, is if you look at the investment grade indices, like they call them iTraxx and CDX, we are long the US and short Europe at effectively the same yield, about 50 basis points. And to us, we look at that as what you would call portfolio left tail risk, because we see, there's a lot of things that could play out badly that would affect Europe a lot more than the US or Europe first. And so it doesn't cost us anything in terms of yield or carry. And yet, we see the payoff as being asymmetric. It's very hard to form a scenario where the US gets hammered and Europe is doing great. Much easier for us to see scenarios where Europe gets hammered and the US is insulated and does quite fine. So that's kind of a trade we're doing there. Canada, Trudeau has really just mismanaged our fiscal situation, almost from the get-go. He'll be out of office soon. Our interest rate sensitivity is very high. Our policy rates are coming down faster and will. So we see them at 4.5, 275 is what's priced in by late fall. We think it should be closer to 2, and I hope they get there in a hurry. I think next week, given that we had a relatively benign inflation print today, I think we'll probably do 50 basis points next week with the Bank of Canada, and I think the bank gets to, and I think neutral. They think it's 275. I think it's probably closer to 2, and they probably have to go at least to neutral, if not accommodative, in a hurry. And I hope they do that in a hurry. And so there's still some opportunities here in Canada. Japan, I think it's a target for Trump, for tariffs. They got one rate hike priced in. I don't think there's much to do in Japan. If you have for the bold of spirit, the yen is always something to do. But there's more than one factor in the yen. And I think the Japanese would be wise to do nothing and let the Fed do the cutting for them and take the currency a bit stronger. And then the UK, we like the UK. I mean, the poor guys, Brexit screwed them up. Their policy rate's at 5. Their terminal rate is priced in is higher than the US, and they've got much weaker, growth prospects. The problem with the UK is the Bank of England has this system where everyone that votes, like think of their version of the FOMC, which is called the MPC, has to go in front of Parliament and justify their vote. So instead of just having the chair go in front of Congress and present a united front for the whole FOMC, and so you're seeing these kind of crazy splits going on right now. I think if you look past that, if you look past the noise and inflation in the short term and their way of setting rates, their interest rates are going to come down more. So we like the UK and we're long that one too. So that's kind of my little trip around the globe. Dave, do you want me to stop here, kind of go into some of my bigger ideas, or do you want to do a little Q&A? What do you think?
Let's stop and have a little chat, and a couple of questions have come in, and then we definitely want to get your bigger picture trades. There was something that you'd mentioned. You talked about Europe, and you talked principally about Germany, but we have a fiscal crisis going on in France, and these spreads off of bonds have really blown out. And I remember, because you have a global hat on, and you were right there when you were correctly identifying that none of these countries like Portugal or Spain or Greece or Italy were ever going to be allowed to default, and you caught that trade. But how are you feeling like about fixed income in France? Has it built up? There's two things: either that gets resolved, and gets resolved, then I mean, of course, they just had a fiscal restraint package, but not so sure the markets really were that impressed with it. But when you're putting your global hat on looking for opportunities, either France is a big buy, or if it's not a big buy, it means that there's real problems lurking there. It's the second biggest economy in the region, and that would be a potential flashpoint for some significant financial problems, and for the euro as well, that could spill over here. So what sort of intelligence can you give us in terms of you're looking over in core Europe in that respect?
So, great question. I would say the analogy is not quite Italy during the European debt crisis. So because Italy's situation was worse, Italy, it was but Italy/Spain, which were both significant countries, but not as big as France. And the mistake a lot of people made during that time frame, during that European debt crisis, and this is where I was getting to about vulnerabilities, is 10-year French German spreads. I was just taking a look there, Dave, as you were talking, it's about 70 basis points. A lot of people made the mistake back then of getting involved in Italy when it got out to say 100. It ended up out at 500, right, when it was all said and done. I don't think France is going out to 500. Okay, so that's it. But I think it hasn't broken yet. So to me, the spread's not yet there to justify a kind of bigger allocation to France. If it got out, if the spread's doubled again, I think it might be worth a closer look. But right now at these spreads, based on historical charts, when people think things are mean reverting, but they're mean reverting until they're not, and they move, kind of thing. And so I think that you're not quite getting paid enough yet to do that. So I'd like to see a bit more of a plan that's viable. If not, I want to see wider spreads.
It seems like, I mean, the one thing that it has in common with Italy, I mean, look, their debt ratio is out of control. People talk about the US. And what unnerves me is, I mean, I'm paying attention, and I write it daily. I haven't had one client question about France, which means nobody's paying attention to it. By definition, black swans or tail risks are things that people are not paying attention to. And this is a much bigger deal than Italy, considering
Right.
the
So
size and relevance of France to the euro area. So that to me is a flashpoint for euro weakness, dollar strength. But remember, when those spreads widened, right, with the pigs, it caused credit spread widening everywhere in every asset class. It was generalized. Who would have thought that if Greece triggered a global risk-off trade.
Yep.
And all of a sudden, we were reading
Oh,
about Greece every day,
right.
but France is not on people's radar screen, and I think that's a significant tail risk.
So I do. I think you have to put it in context. So I was with you, and I was part of. We sold all our Greek bonds at like 95 and watched them go to like 25, right? So I was on the European committee that, portfolio committee that we oversaw the European bonds. So that, again, there was people in our committee and investors going, "Oh, this widened to 100. We got to buy them." It's like, "Oh no, it's gonna go a lot worse." The difference between France today and Greece and Italy and Portugal back during the crisis, the European debt crisis, is the EC, like, while they've still got a very imperfect monetary union with without a fiscal union, the ECB, Draghi in his bumblebee speech has already committed to doing whatever it takes to keeping the union together. So that's why I said I don't think spreads will get as wide. The pain point won't necessarily be as wide as Italy was, because I think the ECB has put a framework together that we will flood the zone with liquidity, and we will take down this debt, which is effectively what they did. We used to joke that the ECB owned the zero coupon Greek perpetual bonds. In other words, you're never getting paid, but we just won't recognize it, kind of thing. And I think the same thing can happen here. They got all these mechanisms through what they call LTROs and financing mechanisms to get money to governments. And that's why I think it can widen, but it may not widen as much as
Right.
before.
Well, it's like the central banks will come in. They're like the firemen. So the house is on fire, they'll come in with a hose.
Bingo. And by the way, and that's the thing, when are they going to come in? I don't think they come in now. Will they come in at French spreads at 150, 200, 250? Probably more there. It's when the firemen will come in with a hose. Right now, there's a smoke at the back of the building, but it's not enough to get, ring the alarm to get the fire truck in, right?
Yeah. Okay. So something else you mentioned, Japan, perhaps not likely to raise rates again, at least for the foreseeable future after that interesting rate hike of 1 or 2 months ago, and the fallout from that. And the new prime minister, we thought was a policy hawk, but less of a policy hawk after some of the comments that he's made. So he made an interesting comment that let the Fed cut rates, that'll strengthen the euro on its own, strengthen the yen on its own, and that will be a form of policy tightening without having to undergo another round of unwinding and carry trade and
Exactly.
general financial instability. But so when you put your investing hat on, are you finding like is there value at the front end of the Japanese curve? When you say is there any value in the JGB curve? Is there any tightening price in the JGB curve that you could say, aha, this is a bond market I want to own right now?
Yeah, no, it's not much. I mean, it's about one rate hike in the next. It adds up to one rate hike in the next year, a little more than a year.
So
So if
nothing's
I just
priced
pull
in.
it up right here, I'm looking at it, and it's like, so for the next meetings that Dave, it's like well, nothing for this month, but next month is, kind of 25% chance, and a 60 and a 70 and 90 and a 90. And then finally by next July, there's a rate cut, next June, call it, there's a rate hike priced in. I think it'll be dependent on the path to inflation, because they're inflation targeting bank. So I think that's it. But I think that, my guess, and it's just, or my forecast or whatever you want to call it, is the Fed will be a lot more active than the Bank of Japan will be. And I think the Bank of Japan would prefer to keep a low profile, right? That's why I brought it up. If there's a Trump election, and he decides he wants to swing the tariff stick around, kind of thing, and he might go to Japan and say, look, I think you've been, Japan Inc., and the whole, carry trade, if you will. And he might say, I think you guys got to unwind that. And then you might, I think the U.S. political environment might force a rate hike or two there, right? But I think it'll be more that, they'll be accused of manipulating their currency by keeping their rates too low, and they may choose to do that. But I think it'd be under quite a lot of pressure from, I'm not sure a Harris administration would do it, but I think there's it's probably above 50% chance that Trump administration might do it. And again, may not actually put the tariff on, but may threaten it and might get them to move. I probably, if you wanted to play that trade, I'd play it more dollar yen than I'd play it in rates.
Look, you're a bond guy, but you focus on all the asset classes. So explain to me this more about your interpretation that we came off these past few weeks with the flurry of stimulus announcements out of Beijing, and it caused the stock market to go vertical north. Of course, it's corrected a bit since, and then you got more announcements. You get people out there saying you got to buy everything in China, and you had all this happening, and yet your world, which is the bond market world, your world, the 10-year Chinese benchmark yield went down to 2.12%. What's that telling you?
Tells me China is very sick. The Chinese economy is sick, and but because the data is poor, they they're trying not to admit it, right? But that's what it's telling me. And remember, before I was telling you that given the closed nature of their financial system and the capacity for it could be democracies and remember everyone thought back in 08 it's so great to be an autocracy because you could just turn on the pipes and everything happens, and the US was fighting over TARP and all these things. But I think when I look at this, I say, you know what, that was then. They're in a much weaker spot now, and the market's not believing them. The bond market's not believing them.
I think that the bond market is, see, this is it. I mean, people are saying to me, what do you think of Michael Hartnett over Bank of America? Gotta buy China. You got Tepper. You got to go along in China. But in some respect, you'd be expecting some impulse out of the bond market telling you, yeah, this is actually a great reflationary trade. The opposite's happened.
Correct.
So I've not been sucking at the teat of this. But when people say, well, why? Everybody else is. So I'm saying, well, what's the bond market they're telling you?
Bond market's telling you it's sick.
Okay.
Now I'll caveat that by
Yep.
saying all Chinese markets are manipulated one way or the other, right?
Oh,
So
not like ours.
yeah, exactly. No, yeah, just manipulated more. That's a good point. All the central banks bought up all the bond markets around the world, but I think the Chinese, let's just say, we do it in a messy fashion. They do it in an efficient fashion.
Okay, so well, a lot of questions are coming in right now, and then I want to get to your big picture views. So what are your best opportunities across the Treasury curve and the Canada curve?
So right now, the highest conviction risk or trade I got on is yield curve steepening. I think we've uninverted the curve, but they're just barely positive. I think you're going to see policy rates drop. It's got a supply problem in the back end of both Canada and the US. And so I think another 100 basis points of steepening is 230s is my base case. So it's not going to happen tomorrow. It's going to take some time over the next year or two. But I think structurally, yield curve steepening is going to be the trade of the next year or so.
That always happens in an easing cycle.
Yeah.
So the question is, where's the best total return potential out the curve then? I mean, you usually get the biggest yield decline at the front end because it follows what the central bank is doing, but the best total return is usually 10s and 30s.
Yeah. So if you're doing retail, the funds I run, I use do the PIMCO style where I use swaps and futures and things, so I can go long 2-year futures and pay on. Right now, I pay on 30-year swaps because it's got a negative swap spread of about 80 basis points. I pick up another 80 bips on that. But so if you can go into funds, PIMCO does it, I do it. That can more efficiently implement yield curves. That would be a better way of capturing on that. To your point, if you're just going to pick a bond, it'd probably be, I don't know. I think the curve's going to see 5s or 10s, probably 10s. To your point, rates dropping, but I can easily see a point too where if the Fed has to pause at 4 for a little bit, and just sits back and watches the data, you might actually get a little bit of a bear steepening in 10s and 30s. As a term premium comes in and they're evaluating the data. Obviously it'll depend on the path of inflation.
Okay. Do you think at what point is the Fed going to stop QT? Because they can't do this indefinitely, cut rates and engage in QT. So what do you think?
hard to say. I wish central banks would be more active with their balance sheets than they are, because I think that way you can avoid having to go to the lower. Like they really have a preference of using policy rates over the bank balance sheet. I have no reason to at this point to see why the Fed would change course on their QT unless something disruptive happened, and I don't see it. So I think they're on a glide path, and they're going to stick to it. And I think here's the thing. I think unless you got policy probably down to 2 or 3%, probably 2, that they'd start to think about being more active with the balance sheet.
More active in the balance sheet in what respect? Do more QT or terminate it?
Terminate.
Okay.
And I think they should. I think they should terminate this stuff, because the last thing you want is to get your policy rates down to zero, a super steep yield curve, which by the way I'd make money on, and then they'll have to come in and re-engage in QE to bring down the term premiums to activate the monetary policy transmission mechanism. So why wait to the last minute? Be more proactive and do it before you get rates too low.
So I'm back on the currencies. Can I surmise? We talked about that the euro was a sick puppy. The UK's got greater prospect to cut rates because they have a lot of catching down to do. So hard to be very, very bullish on sterling. Is your favorite currency the Japanese yen, based on what you said? No rate cuts and let everybody else. So if they're on hold, everybody else is cutting.
Yeah, you know what? Right now, I've got very little. I've got a little small short Canadian dollar going on, and I have, I think the yen is got some like some positioning in there that's very tough to deal with. The euro at 109 is. I don't really have many currency calls right now. So relative to where I've been in the past, this is one of the lighter currency portfolios I've had.
Now, just in terms of Canada, US, Canadian yields trading at a steep discount, but a weaker economy, inflation's falling faster, central bank cutting faster. But in a relative value trade, which of those two markets do you like more? Bond markets, Canada, US.
Bond markets?
Yeah.
I like a little bit right now. I like a bit more the US than but you know what I like? You know what I like a lot of, and it's going to blend to get to my one of my best ideas. I said earlier, I like Fannie Freddie agency mortgages. So what I've done is I've bought TBAs, which are futures on Fannie and Freddie. So it's a simple futures contract, and where I can pick up 150 basis points over, it's about a 4-year duration. So call it 4 or 5 year part of the yield curve. And then I pay on a 30-year swap, and I get that 5s, 30s yield curve to steepen. But you know what? I pick up 150 basis points on the mortgage spread, and then I pick up another 80 basis points because swap spreads are 80 basis points below Treasury spreads. So I can get my yield curve position on plus 230 bips. That's one of my favorite trades.
And so what's the total return expectation on that?
Oh, I would say over the next year, probably high single digits, kind of, call it 8, 9.
Okay. And that's your highest conviction trade. Now, just one last thing before you go on to your big picture stuff. It might be included, but I was intrigued with what you said about the UK. Would you consider that as a region to be your top regional bond market?
So that my biggest overweight duration is in the UK right now. I got about a half a year in the UK.
Duration.
Yep.
Interesting.
And it's like what we call an off index trade. So, I've got the UK first, US second, a little bit of Australia and Canada.
Okay, so spend these last few minutes on, insofar as we didn't usurp all of the your big picture high conviction ideas, take the last few minutes educating.
Yeah, so I think, you know what, I'm looking down my notes here. So the one thing I would say, we talked about the US curve steepener, and we talked about the US agency mortgages we like. We talked about the tail risk about being long US corporates versus short European corporates. So the one thing I would say, and it's kind of central to my fund, to be honest, and my view in the big picture view of the market is, I'm going to be launching private funds and public funds. And the question is, when do you do it? It's, well, when is the illiquidity premium justified? When are you getting paid enough in private markets to go into those private markets? And I would say, back in, when in the pandemic, where you could make 6 to 7 or 8% in the private markets, but you're only getting paid like 1, in the public markets, that was justified, right? Now that, you can generate a total return of, call it mid to high single digits, maybe depending on the year, 7 or 8, somewhere in there, then the private markets haven't adjusted enough. So, what I've been doing in my fund, capitalize, like I think my fund will be the most liquid bond fund, if not in Canada, the US, or the world, because what we're using is very liquid instruments. We're staying away from illiquid, cash bonds, and we're using indices and futures and, things that can trade $1 billion on a penny bid offer spread. So that's, and given our smaller size and more liquid tool set, I think is a real competitive advantage over everybody else out here. So this is what's my idea to be a top tier manager. But I think away from that, but it's philosophically congruent, is if you can get 7 or 8 in the bond market, 6, 7, 8, depending on how you want to forecast. Right now the private markets, with the exception of maybe some commercial real estate, like private debt markets, I should say, with the exception of some really distressed assets like, office towers and a few other things, where I'm sure there's some, babies being thrown out with the bathwater. I don't think the private markets, you're getting paid to be there. So if I was talking to investors, I say keep your powder dry. When people are coming in pitching you on the latest, greatest private debt fund, if you can't pick up, at least 12, if not 15%, I think a 12 or 15% in those markets are around the corner. We haven't, like, when you got stock markets at their highs and investment grade bonds trading at 50 basis points, the blood is nowhere near the street. It's the opposite. The blood is in the veins. So, I think I would keep your liquidity dry would be my number one suggestion to investors out there.
Okay, just before we wrap, just binary questions. Although you and I don't live in a world of 0 or 100, but I want to ask you these questions: 0 or 100. It seems to me, if I said to you, you have 2 choices in the next year: continued soft landing or no landing, or hard landing.
Hard.
We're hard. So
only because you're making it binary. I already gave you my probabilities.
but this is yeah. So there's no fuzzy gray area in between.
Yep.
You can't be
caveated that that's not the way I look at risk. Hard.
You can't. I'm the economist here. I'm the one that can say, okay, on the one hand, on the other hand, you can't do that. Well, that leads you down towards because you brought this up before. Where were we before COVID? In a perfect world of price stability, full employment was $1.75 in the funds rate. That's where we were. And that was the classic soft landing. And we're $1.70. People are saying soft landing today, and oh yeah, we're going to be at 4%. You might be right that we posit 4, but that's not the terminal rate.
No, I agree.
Okay. Higher inflation or deflation?
Deflation.
Okay. Well, I guess that we're joined at the hip on why we like duration in high quality bonds. I suppose that the other question, I guess, would be more open-ended. It's almost like I get asked this question: what keeps you up at night? In other words, what is, and I guess we can't call it a black swan, because if it was a black swan, it wouldn't be a black swan.
Right.
But what is your most compelling tail risk, the things people are not looking at that they should be?
Well, I kind of brought them up, right? So I kind of said, in the short term, it's geopolitics. I think, boy, the probability of something going awry in the Middle East and oil prices shooting through the moon, kind of thing, that's pretty high. Ukraine, boy, that's another kind of one of these digital events that can go kind of either way. I could see, and someone recently, I can't remember who it was exactly. It'll come to me in a second. had a great comment. The Americans can't win too big. If you win too big, there's a tactical nuke in your future. You know what I mean? If so, in other words, you don't want Ukrainians going too far into Russia, kind of thing. So there's a tight little balance there, but between supporting the Ukrainians and a tactical nuke, right? Think about the Middle East. You want to support Israel and be against terrorists, but if you have if you paint Iran too much into a corner and they close off shipping lanes, boom, oil prices go up. How about China? And right now I think China might think they have a closing window on their ability to get to Taiwan before the West has kind of got them pinned in, the first islands strategy that's going on. So that's like, these are like, to me, those are like variables I am not qualified to. What's the old Donald Rumsfeld? There's like unknown unknowns, which was like what you're going, and then there's known unknowns. I'd put those in the bucket of known unknowns.
Well, I've got my own tail risk.
What do you got, Dave?
Which is what continues to underpin my bullish view on bonds as a ballast in the portfolio and a risk-off asset with high-quality characteristics that will never make you a killing. You're talking about high single-digit returns. So there's people out there on NVIDIA that'll say, well, what the heck is that all about? I'll tell you what my principal tail risk is a bursting of the equity bubble. And we will not know why. When it happens, we won't know why. We didn't know why the bull market ended in 1980. We didn't know why the bull market ended in 1990. We didn't know why the bull market ended in 2000. At least initially, we didn't know why the NASDAQ rolled over as much as it did. We didn't know. Why did the market peak in October 07? We all knew the problems in the mortgage market and the ABX indices. But the stock market peaked October of 07, and nobody knew why. Nobody knew why. And it comes down to Bob Farrell's famous refrain: the markets make the news. The news doesn't make the markets. And then the markets will move, and then Wall Street analysts and strategists and economists will fit the narrative to the price action. So I think that, especially because the concentration on U.S. household balance sheets and equities at 70% has never been this high before. So nobody diversified, nobody booked profits, nobody rebalanced their portfolio. So I think the economic repercussions via the negative wealth effect on spending, if the movie runs backward, when people say to me, why are you so stubbornly bullish on bonds? I said, well, this isn't 4 years ago when the stock market was, 60% lower than it is today.
Yeah.
And I look at, so anyway, that's, I had to throw that in. That's my tail risk. My tail risk is a thing that nobody thinks can possibly happen, which is the bursting of the equity bubble. Right. So with all that said, I always have to get in the last word, but we're both actually, I was there thinking, we hadn't talked in since the whole thing with the Fed, they're not going to cut and this and that, and the non-farm payrolls. And I thought, okay, but the thing is that I think in some ways we're more aligned than we were in our last BNN interview. So
by the way, what could cause your one to keep an eye on is the unwind of the Japan Inc. yen carry trade. And I'm talking about the government-sponsored one with Yucho Campo and all those guys. And I think that there was a good Deutsche Bank report on that, and that's a sizable trade in the $5 trillion range. And,
what does that impact over here?
Well, because the Japanese are effectively long U.S. stocks.
Oh, okay.
Right, and
okay.
So
I'm gonna. Well, thanks for the tip.
Yeah. Or risk assets. They're long risk assets which affect stocks.
As if I need more reason to be bearish on the most bullish stock market of the era. Well, look, thanks very much, Ed. We're at the top of the hour, a little past. However, one last question. Where can people on the call find you?
Okay. Well, I right now, if people want to connect with me on LinkedIn, because I do a lot of market commentary and links to our conversations, Dave, on LinkedIn. I have a bit of a X and Facebook page, but I'm not particularly active. We're just ramping up the company, so we're focusing more on portfolios than social media. But you can get a hold of me if you want to email me directly. Is ed@devlincapital.com. We have a website, www.devlincapital.com. And we'll be coming up with a private mortgage fund, very interesting mortgage fund, and probably more institutionally focused in the next few, call it next quarter or two. And yeah, those are probably the best ways to get a hold of me.
Right. Well, there's and you take in institutional money and retail money, right?
We're working on retail, but only qualified high net worth.
But and also, what about financial advisors at the banks?
Not yet, but we're working on it with a couple of, I've got nothing I can announce, but we are working on it.
Okay, well, that's good. Well, look, I can certainly vouch for Ed Devlin. I guess it's one of the few times in my life that I've exaggerated to the downside. I think you're right. 25 years that we've known each other, and you are best in class in your field. But what I've always admired about you is that although you're a bond guy, I think you were actually the bond king back when Bill took
I'm not
the
sure.
moniker. But you're so knowledgeable about all the asset classes, and I want to thank you for your time today. That was really great.
My
Um,
pleasure. Thank you for the opportunity. Really appreciate having a chance to, reach out to your client base, which I know you've earned over many, many years in the market. You've earned your following.
Thank you, sir. Well, just a quick comment for everybody on the call on the next webcast. It's going to come our way next week, October 21st, 4 p.m. Eastern. I don't think this is one anybody's going to want to miss because I'm going to be hosting Neil Ferguson to walk us through what we should all be thinking based on all the possible political permutations that are going to fall out of the November 5th election. So dial into that one. See you all then. And one last tip of the hat to Ed Devlin. And that concludes today's webcast.